I have to start here, James. You had the coronavirus. You spent a month sick at home running an 80,000-person firm. How are you doing?
Well, I'm doing great. Thank you. I'm completely recovered. And, to be perfectly clear, I had the virus, but I was one of the lucky ones. I was not hospitalized. My lungs did not get infected, which is, was a real blessing. And, while it's unpleasant, it's certainly, in those conditions, it's manageable. My heart just goes out to the folks who are not that fortunate or who had underlying health issues and the very elderly who, have really struggled and tragically passed away. I mean, it's a curse, and I just wish everybody well who gets it, and wish them stay hydrated, stay rested, and wish them the best.
I second those wishes. James, Ray Dalio told me yesterday that this is much worse than the 2008 financial crisis. What kinds of base case assumptions are you making at this point for the recession and the recovery?
I'm trying to think. I'm not sure I agree with that. I mean, the economic impact, the GDP decline is obviously much worse, but it's so specific, and it's built around the virus. What kind of world will we have when we have immunity from it, when we have, the right testing? There are so many unknowns now, whereas back in 2008, it was a fundamental collapse of the whole financial system, and had it not been, the system not been rescued, then who knows what long-term damage, multi-decade, might have been to the economy. So, but listen, these were both truly tragic situations. I mean, from our perspective, in running a company, there's, a few things you got to focus on. Number one, we've got millions of clients trading trillions of dollars all over the world. Our plant has to work. We have to be able to facilitate clients doing that so they can manage their businesses. They have to have the ability to manage their own liquidity and funding and capital needs, and we play a critical role in that. In the number one equities player in the world, one of the largest wealth managers in the world, one of the largest capital markets businesses, et cetera. So number one, the plant has to work. And thank God, Erik, with 90% of our employees at home, we've had almost no issues from our plant. And that's just a remarkable testament to the tech and ops teams at this place. The second thing is you do your bit. I mean, we voluntarily cut back on our buyback to zero. We thought it was best to preserve our capital to support clients in need. We're obviously doing everything through our communities that organizations like ours that are large and have resources should be doing. Third thing is to make sure that our teams are properly coordinated given the remote isolation everybody's going through. And we spend an enormous amount of time communicating with them, setting up plans. What would it be like to bring people back to work? Starting to think about what the future might look like.
So it's clearly not as bad, or at least you don't think it's going to be as bad for Morgan Stanley, and perhaps not as bad for the banking industry as the 2008 financial crisis was. What about the broader economy? 5 million people filed for first-time unemployment benefits last week. It's 22 million, in excess of 22 million since this began. How do you fathom or even model the kinds of dislocation unemployment on that scale is going to produce, James?
Yeah, what's the shock to the global economic system is something we haven't seen since the Great Depression. And as you point out, is far more dramatic than what occurred during the financial crisis. And in addition, we have this massive health crisis, which is working its way around the world with at times devastating consequences. You can't model this. I mean, what you've got to do is preserve your capital, make sure you're well positioned to deal with the risks, understand the risks you're taking on as a business, and manage your way through that in a way where the whole team, as I said, is working together. We have, daily operating committee calls. We have risk committee calls constantly. The whole team is organized around how do we ensure that, A, we're doing our job for our clients, and B, that Morgan Stanley remains stable during a period of incredible dislocation.
What will you need to see, James, before it feels like the right time to go from a conservative posture to something with a little more risk appetite?
Well, we're taking risk, all day long. We're supporting our clients, and by doing that, we're taking risks. We have a $900 billion balance sheet, so it's not like we're not in the risk business. We just, we're just conservative. We were conservative coming into this with our profile, and we're conservative in managing through it. What's going to change that? Firstly, the health crisis has to get resolved. You have to see, the flattening of the curve and the shape of the curve change in several countries around the world. We've started to see that in Taiwan, in Korea, in Singapore, in certain places, Germany, it looks like. But we need to see that, particularly in the U.S., I think, and, just look at what's going on in New York City. So, number one, the health crisis has to be dealt with. And then, number two, you have to see more of these poor folks who've been laid off all over the world. I mean, look at the numbers, as you just referenced, Erik, in the U.S. this morning. Another 5.3 million, I think, for unemployment claims. These folks have to get back to work. All the thousands of small businesses just in cities like these. When you start to see that, then you'll start to see confidence creeping back in, but it'll be slow. This is not going to be a rapid turnaround.
It took, as you know, almost 6 months for the market to hit bottom after the Lehman weekend. We're only 6 weeks into this crisis, and already we've seen a powerful rebound. James, what are the chances you think the market has already hit the bottom of this crisis?
Oh, boy. That's a tough question. I mean, my gut is that the equities markets, absent a devastating shift in the health situation, the equities markets have bottomed. That doesn't mean we won't retest those bottoms. We could easily do that. But the volatility you're seeing in the markets right now, 2 to 4% a day. It was 6 to 10% a day a month ago. Fixed income markets also a lot aided by the help of the central banks have stabilized. Much more liquidity in the system. So my gut is that the markets were at their highest point of instability 3 or 4 weeks ago. That could be retested. I think it's unlikely from a liquidity perspective to be retested. From an equity value, it might be. But, we live in an extremely uncertain world for the next few months. But every day that there's progress in a country, every day that you're seeing declining rates of infection and obviously the tragic deaths that flow from that is a very positive day to getting the world back on its feet.
Hedges helped your firm offset some of its credit losses in the first quarter. How hedged is Morgan Stanley at this point, and what kinds of protection have you put on?
Well, I'm not going to go into details of how we've hedged the institution, but needless to say, it would be imprudent not to have done that. And yes, it mitigated our losses by approximately 1/3, I believe, across our trading businesses. This is something that if you're in this business when, frankly, nobody can tell me what the market will do tomorrow, so anybody who thinks they know what it's going to do over the next several months is dreaming. So you have to be conservative and mitigate your downside risk.
Even though those hedges are much more expensive to put on now than they were, say, in January or February.
Sure, it's why you buy insurance for your house, particularly if you live in a flood zone. Absolutely. That's a no-brainer.
Morgan Stanley's institutional clients drew down billions of dollars in revolving credit lines over the course of the first quarter, and as we've learned today, there's billions more that can draw. What were those conversations like, James? I'd love to know, particularly with those clients who were not drawing down because they needed the money, because they were either thinking themselves prudent, perhaps fearful, or even panicking.
Well, listen, I had those conversations. I had some of those, and the CEOs I talked to, they've got to do what's in their best interests. We have these revolvers. They're entitled to draw them down. Obviously, not all of them wanted to do that, but they've got to operate what ultimately is in their best interest, and that's what a number of institutions did. And do I begrudge that? Not at all. That's what we're in the business of doing, is supporting our clients.
As you've mentioned, some 90% of Morgan Stanley's 80,000 employees are working from home. It's a staggering figure, of course, one we've seen repeated across the industry and many industries for that matter. It's amazing, though, that it has come, at least by your admission, with no major loss of capability. What I'd like to know is, how does that change the way you think about the way this firm operates in the future? We've
just started, and I guess it's a good sign, right, that we're starting to talk about the future. The last couple of operating committee calls have been focused in part on what the future might look like, and we're starting to sort of, play out tabletop what that could be. Clearly, we've figured out how to operate with much less real estate. That, number one, right off the bat. Now, do I think everybody's going to be working from home? No. I think the mentoring, the connection, the team bonding, the brainstorming, the creativity that comes from being in groups of individuals like-minded and not like-minded. That's how great organizations thrive. But can I see a future where part of every week, certainly part of every month for a lot of our employees will be at home? Absolutely. By the way, it saves on all the commuting time. It gives them more capacity in that regard. People have been functioning extremely well. So it's a grand test. Somebody said to me the other day, if you'd asked us in January to tell all our employees as a test run, 90% of them to go and work from home, and let's see what happens, nobody would have taken that risk, right? You'd think the whole place could stop. And yet we were forced to take this test, and guess what? We came out the other side of it. So that tells you an enormous amount about where people need to be physically, not just all the time, but some of the time. I'm still, though, a huge fan of mentoring and bonding and having teams together and the creative surges that come from having people working together.
Is it a natural conclusion that a firm like Morgan Stanley and perhaps other firms in your industry are not going to need as much of a footprint in places like Manhattan, London, Hong Kong, and that something about the character of this industry, Wall Street, let's call it, is going to change permanently as a result?
No, I don't think that. I mean, I'm sorry, I'll take the two parts of the questions. I think, yes, we will have less footprint. I think that's highly likely. We've proven we can operate with effectively no footprint. So now, on the other hand, as I said, I want most people in the office most of the time. So no, I don't think the character of the industry will change as a result of that. I think what has been informally done with the number of employees in the last few years migrating to a day at home will become, over time, much more of a formal structure that we probably evolve to.